Hello, everyone, and welcome back to the Deep Dives. This is the place where we really try to cut through all the noise and deliver the essential, enduring knowledge you need to understand the world's most critical businesses. I hope you are ready, because today we are strapping in to analyze a true giant of the semiconductor world, analog devices, or ADI. Now, we're not looking at just another chip maker. We're examining the global leader in high-performance signal processing. I mean, ADI is literally everywhere, serving as the absolutely essential translator between the messy physical world think temperature, pressure, motion, and the clean digital language that our computers and AI systems run on. It's an objectively phenomenal business, and because of that, it consistently commands a premium valuation from investors. And that, right there, is our central puzzle today. The question we are here to answer is this: can a company whose products are inherently tied to some very cyclical industrial and auto markets actually deliver premium, non-cyclical compound returns? We really need to figure out if their powerful, designed-in moat is strong enough to justify the high price investors are paying for this kind of quality. That's our mission.
That is a massive question. And it's so nuanced because for these kinds of compounders, the valuation hurdle, the expectation for perfect execution is often the highest barrier. We have to dissect the fortress ADI has built brick by brick. But before we get into the weeds, just a quick note for everyone joining us.
For those of you who want to act on some of these investing insights, having a professional-grade platform that can handle, proper analysis and execution is absolutely key. We use Interactive Brokers, and we've actually partnered with them to get our viewers a stock bonus when you sign up using our special link.
So you get a bonus that helps you build your portfolio, and you support the channel at the same time, which lets us keep doing these deep dives. That link is in the description, right?
That's right below. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to make sure you get to the next one is to subscribe and hit that like button. It truly helps the channel grow. And if you have any specific questions about ADI or the analog world in general, please just let us know in the comments below.
Perfect. Now, let's jump right into the core analysis. We have to start with pillar number 1, the business model. We need to establish just how indispensable ADI really is.
Okay, let's unpack that. When the average person thinks about semiconductors, they're probably picturing a CPU or a GPU, right? These massive digital chips that are all about computation and speed. But ADI operates in a fundamentally different space, and in many ways, it's a much more enduring one. They're the interface, the translator. How do we explain that simply?
Well, think of the physical world as speaking a continuous, messy, infinite language. That's analog signals. It's light hitting a sensor. It's sound waves. It's the tiny vibration of a machine part that's about to fail. Our computers, though, they only speak one language, 0 or 1, digital. ADI makes the chips that translate that messy analog language into clean digital language.
So it's like the difference between a smooth wave of water and a set of distinct countable drops.
Exactly. And if you mess up that first step, if your translator is bad, all the data going into that giant digital processor is garbage. The whole system is useless. So the quality at that first step, the input stage, is absolutely paramount.
Which is why ADI is so essential. They sell thousands of these unique proprietary components that do this critical translation. And crucially, they operate right where the data is born, at what we call the intelligent edge. We hear that term intelligent edge all the time now. How does that contrast with the cloud? Why is operating at the edge so important for ADI?
The cloud is where the heavy lifting happens, the big computation after the data is collected. But the intelligent edge is where the actual interaction with the physical world happens. For ADI, that means their chip is the very first component in the whole signal chain. So imagine an automated factory. The data isn't generated on the cloud, it's generated by 1,000 sensors on motors and conveyor belts. ADI's chip is sitting right there, translating pressure and temperature into digital data milliseconds before it ever goes up the network.
Right. And if that little component fails, or it gives you noisy, unreliable data, then the super smart predictive maintenance algorithm running in the cloud is completely useless.
You crash the motor.
You crash the motor, or you send a wrong signal to a robot arm. In that kind of high-stakes environment, quality and reliability are going to trump price every single time.
And that's the structural relevance. That's why this business model is so likely to remain relevant for decades, regardless of how fast the digital world evolves. The physics of signal processing that need to convert physical data cleanly and precisely, that is fundamentally enduring.
It's not some software platform that can just be replaced by the next killer app.
No, this is physical laws meeting silicon design.
And they seem to be perfectly positioned for every major tailwind driving the economy right now.
Yeah.
You've got this convergence of electrification, automation, Electrification, 5G, AI expansion.
Let's start with electrification. The move to EVs, modernizing the grid. This needs unbelievably high-precision power management and sensing for things like battery cell balancing. A battery pack has hundreds of individual cells. If one cell overcharges or overheats, you risk thermal runaway.
Which is a catastrophic failure. A fire.
A fire. ADI provides the chips that monitor voltage and temperature at the sub-millisecond level, making sure every single cell is perfectly balanced. This just dramatically increases the content, the dollar value of ADI chips inside every single EV.
And then there's automation, or Industry 4.0. Factories are becoming, well, hyper-connected. Every machine is basically a mini data center. That guarantees demand for their specialized sensing and processing.
It's the whole shift from periodic maintenance, checking a machine once a month, to predictive maintenance, which demands thousands of reliable data points from every piece of equipment all the time.
And communications, 5G and 6G infrastructure. Those massive antenna units need incredibly sophisticated radio frequency and power control solutions.
Absolutely. ADI's mixed signal expertise is just essential for handling the signal integrity in those high-frequency bands.
It's a convergence, right?
Yeah.
Increased connectivity and energy efficiency naturally increase the content of ADI solutions inside the end product.
Which brings us back to that mental model we like to use, the toll bridge. How does ADI embody being a toll bridge with a really deep moat?
Because ADI sits at a necessary choke point. If you decide you're going to participate in any of these massive tech shifts, building an EV, designing a medical scanner, launching a new industrial robot, you must use a high-performance analog solution to get physical data into the digital world reliably. There is just no viable substitute for this function.
And because the chip itself is such a tiny fraction of the total cost of the end system, but it's so mission critical,
Right.
ADI has the power to take a small, non-substitutable toll on every single piece of equipment, capitalizing on these huge trends. It's just a classic high-margin setup. And that predictability, driven by these really long structural product cycles, that's the foundation for their premium valuation. It's a business designed for endurance.
Okay, so we've established the business model is enduring. Now let's talk about the specific architecture of the moat around this toll bridge. The primary economic moat here is high switching costs. And in the analog world, that is so much more complex and durable than it is in, say, software.
The term we have to use here is the designed-in dynamic. This is the core reason for ADI's incredible stickiness and their sustained pricing power. And we have to be crystal clear on this. These analog chips are not interchangeable parts. They are not commodities. They are intrinsically integrated into the DNA of the customer's product.
So what does that really look like for a customer? Let's say a tier 1 auto supplier building a new radar unit. What's that commitment?
It means that the analog component is engineered into the system very, very early, sometimes 3 to 5 years before the end product even hits the market. The radar unit's power delivery, its thermal management, the noise reduction algorithms, all the little passive components around it, they're all custom tuned to the exact specifications and even the physical layout of that specific ADI chip.
It's a really intimate design process.
It is. It's holistic.
And this is where that famous cost-benefit paradox comes in. So if the customer is building, say, a $3,000 radar module and the ADI chip in it costs $10, why wouldn't they just switch to a competitor who offers one for $8?
Yeah.
$2 is $2.
Because the $2 savings are completely irrelevant compared to the prohibitive cost and time of switching. If that supplier tries to swap out the $10 chip for the $8 one, they're not just swapping hardware. They have to re-engineer their entire system architecture. They might have to redesign the circuit board. They have to rewrite firmware to accommodate the new chip's drivers, then re-qualify the entire product line for automotive safety standards like ISO 26262.
And then retest it.
Extensively, over months, often at a massive cost.
We've heard stories, right? An engineer tries to swap out a single sensor and they lose 6 months of development time and rack up millions in requalification fees.
That's the reality. For the customer, the potential savings on that tiny component are just completely dwarfed by the risk of delaying a product launch or, even worse, compromising the reliability of a mission-critical system. The financial incentive is just to stick with the known proven component.
And that means once an ADI chip is designed in, it's basically sticky for the entire life of that product, which could be decades. I mean, what a magnificent anchor on long-term cash flow. It gives them incredible visibility and pricing power.
And this moat isn't static. Our analysis suggests it's stable to widening. Complexity is their friend. As AI and electrification demand deeper specialization, the design requirements just get exponentially harder. That reinforces the advantage for market leaders who already have that deep proprietary design know-how.
And the second structural factor is just industry consolidation.
Hmm.
That acquisition of Maxim Integrated was key, wasn't it? It seemed like it was less about acquiring new technology and more about just reducing the number of large-scale competitors.
That's a huge part of it. They essentially bought a competitor's moat, and in doing so, they strengthened their own.
And this sticky relationship, it's not just about the tech, it's about trust and quality. It's what investors sometimes call scuttlebutt. We have to look at customer sentiment to confirm the moat is real.
Right, when we say scuttlebutt, we just mean getting that ground-level intelligence about a company's reputation and quality from the people who use the products every single day.
And the data on ADI's reputation is, well, it's unequivocal.
Yeah.
They are consistently seen as a best-in-class, dependable supplier. Their Net Promoter Score, or NPS, is 36. For a B2B component supplier where relationships are more functional than, enthusiastic, an NPS of 36 is incredibly strong.
Yeah, that's really high for B2B.
It shows that a huge majority of their clients are not just satisfied, they're active promoters.
But the most compelling metric for me is their product quality rating. Long-term customers, the ones who've relied on these chips for 5, 10 years in mission-critical applications, they rate them 5 out of 5. That tells you they aren't just selling a chip, they are selling certainty. They're selling reliability and long-term support in these incredibly complex, high-stakes systems.
And that dependability, that's an intangible asset in itself. It's a reflection of the culture and the deep, specialized engineering talent that they have. That talent is the moat.
Now, we do have to address the competitive environment. In high-performance analog, it really is a duopoly at the very top. I mean, you have other players like Infineon and STMicro, but the fundamental dynamic is really defined by Analog Devices and its primary competitor, Texas Instruments, or TXN.
And what's so interesting is that they're both incredibly high-quality, successful businesses, but they employ two really distinct strategies. Let's start with TXN's approach. What's their game?
TXN leans hard into manufacturing scale and vertical integration. They have a higher CapEx model because they're focused on owning more of their own fabrication capacity. Their strategy is all about breadth and throughput. They want to serve the entire analog market, from the simplest high-volume commodity components all the way up to high-performance parts. Their goal is maximum efficiency through total control of that manufacturing chain.
So they often win on massive volume and cost structure in segments where things are a bit more standardized. ADI, on the other hand, takes a clear performance-first approach.
Exactly. They specialize in the higher performance, more complex signal chain and precision power management solutions.
Yeah.
The stuff that requires the deepest engineering specificity.
And that focus naturally dictates their target markets, right? They're concentrating on the most demanding, highest margin applications, high-end industrial, sophisticated defense and communications, mission-critical automotive.
They're selling deep engineering IP, not just manufacturing capacity.
Which brings us to their key strategic differentiator in operations, that hybrid manufacturing model. It's so different from TXN's fully integrated approach. Can you explain the strategic benefit of that hybrid model? Using their own fabs for some things, but also using foundries like TSMC for others.
The benefit is flexibility and, crucially, higher returns on invested capital, or ROIC, over the long term. Analog processes are really unique. ADI keeps its internal fabs running for its proprietary, highly specialized manufacturing processes, the most sensitive stuff. But when they need access to cutting-edge digital nodes or just standard high-volume capacity, they leverage external world-class foundries.
So they get to avoid the constant burden of these massive, multi-billion-dollar capital investments required just to maintain pure manufacturing throughput. That's a major drag on CapEx for the more integrated players.
Exactly. They can allocate a larger portion of their capital to R&D and proprietary design, the IP that strengthens the moat, rather than just sinking capital into depreciating manufacturing assets. It's a strategic trade-off. TXN gets maximum control and cost advantage at scale. ADI gets greater capital efficiency and the ability to pivot faster to cutting-edge processes from partners without having to build it all themselves.
And that distinction is so critical. It explains why ADI can achieve such phenomenal free cash flow conversion rates, even while being a leader in advanced chip design.
And that, right there, is ADI's durable competitive advantage. It's that engineering depth in high-precision mixed-signal ICs. The complexity barrier is just rising so fast, especially at that intersection of analog and digital, that their focus on these really demanding applications means the designed-in stickiness of their parts is deeper and more durable than in the general-purpose segments where competitors can more easily get a foothold.
They're selling performance, and that's what justifies the premium. So moving on, we've established that the business model and the moat are absolutely world-class. But quality like that requires world-class stewardship. Let's dig into the leadership philosophy of CEO Vincent Roche and the capital allocation discipline that really defines ADI.
Roche has been there a long time, since 2013, and he really embodies a long-term, owner-oriented mindset. He's consistently focused the company on two things: relentlessly going after the highest value opportunities at the intelligent edge, and maintaining an innovation premium that justifies those high margins. That philosophy, it just permeates all their operational decisions.
And you see that long-term focus directly in their capital allocation. When you look at where the cash goes, it's just entirely rational, primary use.
Yeah.
Reinvestment in R&D and securing that hybrid manufacturing capacity to deepen the moat. But it's the commitment they make with their excess cash that really signals that strong owner alignment.
You have to highlight the 100% free cash flow commitment. They have a stated policy to return 100% of their free cash flow, their FCF, to shareholders. They do it through a combination of consistent dividend growth and calculated share buybacks. That is an incredibly strong signal to the market. It tells you management believes their own stock is a highly attractive investment when internal R&D opportunities fall below their high hurdle rate.
That really is the gold standard of capital discipline, isn't it? They're not just hoarding cash for some unnecessary empire building. They're committed to giving it back. And we've seen that consistent dividend growth, an 8% increase, is expected in 2025 alone.
And their M&A track record has been good. I mean, the Maxim acquisition was a complex multi-billion-dollar deal, but it was strategically sound. It increased their scale, it reduced the number of top-tier competitors, and was rapidly accretive to earnings. They showed they could execute a massive deal without hurting the core innovation engine.
And that discipline creates a true financial fortress, which is essential for a company that has to navigate the cycles of the industrial world. So let's look at the quality ratios, starting with profitability, because these margins, they just speak volumes about the depth of that moat.
The gross margins are exceptional. They're consistently hovering near 70%. Operating margins are consistently in the 40+% range.
70% gross margins. Just for context, in the broader semiconductor industry, that is considered best in class.
Yeah.
It's usually reserved for like a software or IP business, not hardware.
It just demonstrates incredible pricing power, which is secured by those high switching costs. When you have a 70% gross margin, it tells you that price competition is pretty much non-existent in your core high-performance segments.
And the return on invested capital, the ROIC, that just confirms the strength and efficiency of the business model. It moves around a bit after big acquisitions, sure, but ADI consistently maintains a high ROIC that's well above its cost of capital.
It proves management is not only using shareholder funds efficiently, but that the business itself earns high returns on that capital because of its structural competitive advantage.
I think the FCF conversion is arguably the most impressive metric, though. This is the quality of earnings we'd love to see. They're projecting a record free cash flow of around $4.3 billion for fiscal 2025. That's about 39% of their revenue.
That is an exceptional conversion rate, nearly 40 cents of every dollar in revenue turning into pure usable cash flow. And that is a direct result of their strategically capital-efficient hybrid manufacturing model.
Right, and that cash conversion is the fuel for that 100% shareholder return commitment. So finally, let's just touch on the balance sheet. A high-quality company has to be ready for the inevitable downturn.
And they are. Their net debt to EBITDA ratio is conservative. It's around 1.1x. For an industrial tech giant, that is remarkably low. And that debt load is easily manageable. Their EBIT covers their interest expense by over 12 times.
So no liquidity risk.
Zero liquidity risk during a downturn. And critically, it means they maintain optionality. They can engage in strategic M&A or do massive share buybacks when markets are distressed and assets get cheap.
Okay, so we now shift to the growth story. As we mentioned, ADI isn't growing through, massive volume increases in commodity chips.
Yeah.
Their primary growth engine is what we call the content story.
And this is so critical. The content story is the main link between all those secular tailwinds and ADI's bottom line. It just means that within every single application, an EV, a factory robot, a medical device, the dollar value or the content of ADI's high-performance solutions is increasing dramatically.
Can you give us a tangible example? How does content drive growth faster than just pure volume?
Okay, take automotive electrification again. A traditional gas-powered car might need, say, $50 to $100 worth of analog content for engine management and basic infotainment. A modern high-range EV, however, requires somewhere between $500 and $1,000 worth of content. And that's primarily driven by the complex battery management systems, high-speed charging components, and sophisticated ADS, radar and LiDAR sensing systems.
So the volume of cars sold might grow by, say, 3% a year, but ADI's revenue from the average car sold grows by 10% or more. And that just compounds over time.
Exactly. And that story is particularly potent in industrial automation and automotive.
So what are the catalysts that could accelerate earnings even beyond the structural growth?
The single biggest potential catalyst, I think, is an AI-driven industrial supercycle. AI requires massive amounts of data, and the quality of the AI output is only ever as good as the quality of the data input. And because ADI sits at the very start of that signal chain, providing the clean, high-precision data from the physical world, they are an essential prerequisite for any real AI implementation in a factory or a machine.
So if companies suddenly accelerate their CapEx, not just buying new equipment, but overhauling old equipment with advanced sensing to enable AI and robotics, that would trigger a multi-year, non-cyclical surge in demand for ADI's components.
It would be a cyclical bump perfectly aligned with a huge secular trend.
What's the second catalyst?
Continued margin expansion. We talked about the Maxim integration. If they keep realizing synergies from that, both cost and revenue efficiencies, they could push their already exceptional gross margins sustainably above 70%. And that margin expansion just drops straight down to the free cash flow line, which is critical for a premium valued stock.
Okay, now we have to face the elephant in the room, valuation.
Yeah.
AGI typically trades at a high premium. I mean, historical PE ratios are often in the 35 to 50 times range.
Yeah.
Why does the market give this premium to a company that, at the end of the day, sells hardware into cyclical markets?
The market pays for predictability. It pays for quality, and it pays for management stewardship. They see the strength of that designed-in moat translating directly into a predictable, sticky, high-margin cash flow stream that stretches out over multi-decade product cycles. In a hardware world that's often plagued by rapid obsolescence, that kind of predictability is a rare commodity. And investors are willing to pay a high multiple for that enduring quality.
Which fundamentally changes how we have to define a margin of safety, doesn't it?
Yeah.
You are never going to find ADI selling at a cheap 10 times PE. So where do we find an entry point? Where is the safety?
You find it when a perception temporarily deviates from reality. So the first scenario is a company-specific but temporary setback. An industry-wide inventory correction, something the semi-world sees all the time, or a short-lived dip in one big end market like automotive. These events cause a temporary drop in earnings, they trigger an indiscriminate sell-off, and that allows you to buy that superior long-term stream of cash flow at an uncharacteristically low multiple, maybe 25 or 30 times PE.
And the second scenario is just a broad market panic, a systemic macro shock that drives down all high-quality stocks indiscriminately, along with all the speculative names. Those are the times when financial discipline and a deep understanding of the business really pay off.
But we also have to outline the permanent impairment risks, the existential threats that could fundamentally break the thesis, however remote they might seem. First, technological obsolescence. A disruptive leap, maybe in quantum computing or some new photonic sensing paradigm, could potentially render traditional silicon analog design less relevant. That would just undercut decades of their accumulated know-how.
The second one, and this is perhaps more insidious, is the loss of the design and moat. If system architecture shifts, maybe through better open source standardization, or if software advances enough to abstract away the hardware specifics making analog parts easier and cheaper to swap out,
then ADI loses its primary source of high switching costs.
and if that happens,
ADI quickly moves from being a specialized high-margin Tollbridge to a commodity price taker, and those 70% gross margins would structurally collapse. And finally, there's a talent exodus risk. Their moat is based on rare, highly specialized analog engineering talent. A significant loss of key design teams would cripple the innovation engine they need to maintain their performance edge.
we've laid out a really powerful bull case. It's built on structural growth, financial quality. Now we have to perform the critical exercise of subjecting it to the toughest counterargument, the red team challenge. The prevailing market narrative, as we've said, is that ADI is a wonderful growth compounder, and the only real concern is maybe some short-term cyclical dips.
The contrarian view, which is where we look for the blind spots, suggests the market might be completely right about the quality of the business, but severely underestimate the long-term risk associated with the price you pay today. The most compelling bear case does not rely on some outright collapse or immediate technological obsolescence.
It relies on a slow, incremental, structural failure. a combination of slow commoditization and what's called secular multiple compression. This creates the disastrous double hit that is the greatest threat to achieving premium returns.
Let's detail that first hit. Moat erosion and margin compression. The high valuation, that 40-plus PE, is predicated on ADI's ability to maintain its best-in-class profitability, specifically those near 70% gross margins, forever. But what if competitors, especially state-backed enterprises from regions like China, slowly but surely become technically proficient enough to serve the medium to high end of the market? Not the absolute bleeding edge, but the 80% segment. Or what if system integration changes just allow easier substitution? That designed-in moat slowly erodes at the edges. So this erosion means ADI loses its absolute pricing power. They're forced to compete more aggressively on price to maintain their market share. Even if they're still the best, a fractional loss of pricing power due to more competition forces, that 70% gross margin structurally lower, maybe down to 60 or 62%.
And if that margin compresses by even 10 points, their ROIC declines and their cash flow generation is severely impaired. The business is still good, it's still profitable, but the quality, that scarcity premium, is degraded. That is the first hit on intrinsic value.
And then comes the devastating second hit, multiple compression.
Right. Once profitability and structural quality decline due to that margin erosion, the market will rationally re-rate the stock. It moves from being treated as a wonderful growth compounder, commanding that premium 40 times PE, to being treated like a mature industrial cyclical entity.
And a mature cyclical, even a high-quality one, might only get a 15 to 20 times PE multiple.
And just imagine the math on that. A company earning $10 a share today valued at 40 times. That's a $400 stock. If its earnings quality declines a bit and its expected forward PE gets cut in half to 20x, even if its earnings only drop from $10 to $9, the stock price doesn't just drop from $400 to $360. It drops from $400 to $9 times 20, which is $180. That is a permanent, catastrophic destruction of shareholder value over a multi-year period, even though the business itself is still profitable and avoids collapse.
The outcome is clear. That double hit is the greatest risk to long-term returns for an investor buying at today's high premium. The market is betting on perpetual 70% gross margins and perpetual premium multiples. Any structural challenge to those two things means overpaying today just exacerbates the risk of those multi-year negative returns.
Absolutely. The erosion of that premium margin is the ultimate existential threat to the investment thesis because it invalidates the high price paid for the stock today.
So to synthesize this entire deep dive, the investment thesis for analog devices is immensely strong based on its fundamental quality. The bull case rests on its high performance, designed in sticky moat, the structural growth from AI and electrification, the exceptional free cash flow, and world-class management. They have cemented their leadership position.
The bear case acknowledges the cyclical vulnerability and, most importantly, the high valuation, which creates execution risk. But the most serious long-term threat is that slow structural margin erosion driven by incremental commoditization that leads to that disastrous double hit of lower intrinsic value and a compressed multiple.
In the end, it just comes back to that classic Buffett principle. Price is what you pay, value is what you get. The risk here is not necessarily a permanently impaired business. I mean, ADI is likely to remain a dominant, high-quality chipmaker for decades. The risk is permanently impaired returns because an investor overpaid for future growth that may be structurally challenged by margin erosion down the line.
It's a game of patience and price discipline, waiting for the cycle to correct or for a broad market panic to provide that necessary margin of safety is just critical for truly compounding wealth with a stock of this caliber.
And that leads us to a final provocative thought for all of you to consider, based on their unique operational setup. ADI's superior free cash flow generation and its high ROIC. They rely heavily on its hybrid manufacturing model, the one that's less capital intensive than a giant like Texas Instruments.
Yeah.
But in an increasingly bifurcated nationalistic world that demands supply chain resilience, how vulnerable is that capital-efficient model to geopolitical risks? Risks that could suddenly force a massive localized increase in capital expenditure just to secure capacity. If they were forced to suddenly build out massive internal capacity, basically adopt the TXN model, it would inevitably impair their high FCF conversion rate and their ROIC for years. This is a fundamental question about weighing resilience versus capital efficiency in the current global climate.
A question worth mulling over as you think about the future of the intelligent edge and the price of quality.
Thank you for joining us for this deep dive into analog devices. We'll see you next time.